Hi, thanks for tuning in. Today we're discussing how I trade Elliottwave corrective patterns. We're going to use this little chart I put together as an example. It's a very high level view. Ideally, we're looking at stocks that are coming off 52-week highs that have just completed an ABC corrective pattern on the daily and or weekly charts. Before we enter, this is my swing trading system that I'm going to explain to you in the next 5 to 10 minutes. The process itself can best be described as me putting together a puzzle, one candle, one day at a time, 1 hour at a time, and slowly reveal the picture of the pattern that the market is in the process of revealing. The supply and demand balance and imbalance is what drives the formation of these patterns. A lot of the time as a swing trader, we sit and do nothing, and so I'm going to try to show you how I manage active trades. So right here, we're going to assume that we're buying the 2 wave low. We never want to buy a wave 1, and we never sell a wave 5, right? That would be trying to guess a top or guess a bottom. That's not the game that we're in. We want to buy after there's been evidence of buying, and that comes in some form of a wave 1. Wave 2 psychology is very bearish. Most people believe that the bear market is still in play. They don't understand the opportunity at hand and that the risk really is to the upside, not the downside. That being the case, these wave 2s can take a lot of time. They can drag out. And it's certainly not easy buying there. Some traders like to wait until wave 3 has begun before they buy, which is also referred to as a breakout trading system. I trade a mean reversion trading system, which is really where price reverts back to an average, typically, the 20-period simple moving average. So we're looking to buy after an ABC correction has occurred. These corrections generally take between 6 and 9 candles to complete. Every reversal sign needs confirmation. There are traps everywhere in the market. Confirmation comes in the form of multiple candle closes above or below certain price levels. So every correction pattern starts with one of the 5 reversal signs: outside candle, engulfing candle, a gap, a big wick on the chart, or some type of doji with volume. And they will end with one of the 5 reversal signs, and they typically end 6 to 9 candles later. Once they end, that's what starts the next impulse wave. These impulse waves can go on a lot longer than most people think. It's the obvious part of the trade. It's the part where Kramer is talking about it on CNBC, and when you log into Twitter, everyone's referencing it. That's the wave 3. That's where we make all of our money. But we have to be sellers in wave 3 as you reach some form of peak, 6 to 9 candles later, hundreds of percents later. And we're not looking at selling everything. We sell in lots, just like we buy in lots. We scale in, we scale out. So we'll look to sell as we hit certain Fibonacci extensions, certain horizontal price levels, and after we've seen confirmation of a reversal sign. So if we follow this chart here, this doji was the end of wave 1. 6 candles later, we had another doji that started the start of wave 3 and completed the correction pattern. Wave 3 went for 1, 2, 3, 4, 5, 6, 7, 8 candles. This then put in another sign of a reversal, this big wick. We have an ABC correction, which took 7 candles. And then another wave 3 ascend. 1, 2, 3, 4, 5, 6, 7, 8 candles later, a doji, big upper wick. Another sign of a reversal. This is telling you that the bears have taken the ball back. We're looking to wait 6 to 9 candles for signs that this is completed. This, in fact, is a ascending triangle. 1, 2, 3, 4, 5, 6, 7, 8. We're completing the final wave of this 5-wave move up. It completes with a doji, a very short wave, just like wave 1 was very short, very symmetrical wave 5. This then started a correction. 1, 2, 3, 4, 5, 6, 7. The A and B, massive 5-wave move down C. This went on for a very long time. 1, 2, 3, 4, 5, 6, 7. 1, 2, 3. 1, 2, 3. So the market loves to move in 3s, 5s, 7s, 9s, all the primes. But the point is, we're looking for a reversal sign to show up somewhere between 6 and 9 candles later. It will give the trader something to trade against, a horizontal price level. And once you have that, you can measure your risk, which is the distance to that level, versus your reward, which will be some of your profit targets. And if you look at when you are looking to sell into strength, selling 50%, buying back the 50%, selling 50%, buying back the 50%, and ultimately exiting the entire position near the top, you will avoid having to sit through a major ABC correction. And these corrections, they happen all the time. They're one of these 6 corrective patterns. From a structure standpoint, these waves still break up into 3-wave move or 5-wave moves. The 3-3-5 or the 5-3-5s. So your zigzags and flats are what you see almost everywhere. And if you're anticipating a zigzag and a flat, then you will more likely than not be protected against any massive downside risk. If you're anticipating an impulse wave up, and you're really actually somewhere in wave 3, 4, or 5, the zigzag correction that comes will be the end of you and likely be what takes all of your gains back. So if you spend most of your time focused on mastering the corrective patterns, you will keep the money that you make. And anyone can make money in the market. It doesn't mean you're a genius. It takes skill to keep the money that you make. So that being said, that concludes this video.